Then let it be. I don't know what it done told you. Don't let them fold you. Keep it the letter G. Humble yourself with the patience. You got a pace to get where you wanna be. All the pain just show that you seasoned. Gotta believe it. Just give me the cheat code. And none of the struggles come with the glory. Tell them to keep those. All of the pain just come with the game. I treat them like free throws. All of the evil sticking around. I had to delete those. Yeah, I had to defeat those. Just give me the cheat code.
What's good? What's good? What's good? We are live. Let me turn on the chat here, make sure I don't miss anything. Let's go. We got Real TV in here dropping comments. Let's go. Y'all make sure you hit that like button. Today, we're going to talk about the effects of inflation and interest rates on the stock market and what to watch. Okay, so the last few videos, if you haven't been following along, we've talked about things to watch in order to be bullish, bearish, as well as how to use the dollar as a powerful strategy to be able to watch the markets across every market, crypto, commodities, futures, Forex, you name it, you can use the dollar trading across it, okay? Now, another thing we talked about was bearish and inverse ETFs. Those are important tools that you all can use in order to hedge or use them as a tool as an inverse to the market, right? So when inverses are finding support, then the market is usually at resistance and vice versa. Okay, so today, like I said, I want to talk about the effects of inflation and higher interest rates on the market. So right here on my screen, I actually have, and if you got any questions, drop them in the comments. Make sure you hit that like button. Hit that like button. Hit that like button. And share this with a friend. Drop this link to a friend. Send it in a text. Send it on the Discord, wherever you need to drop it. All right, let's get into it. So right now on the screen, and like I said, if you have any questions, make sure you ask. Drop them in the comments. I will be checking them. So right now on the screen, we have the 10-year Treasury yield bonds. Okay. So this is US 10Y, okay, US 10-year. All right. You can also use some I noticed some platforms don't have it. The TNX is also another one that you can follow. It's not actually in percentages, it's rather it's in dollars. So you can actually follow this. It actually tracks this like an index would, right? So we actually have the TNX that you can use to track this. Like I said, this is not in percentages, but if you actually use the 10-year index, which is US 10Y, this is actually going to be in percentages, right? So when you talk about bond yields are increasing, this is what's happening, right? So when they were like, oh, this is the highs we've seen, or this is some of the highs that we've seen previously in November, which is right in this area, you can see that we're running into these highs because we really passed this peak that we saw in December here. So what I'm going to do here, when you're looking at these charts, you always want to pay attention to where did we get some reversals. So I really want to focus in on here because this had a rejection. So we're going to say 3.9% is a roundabout number that we can say. But remember, I always tell you, you don't want to just be hitting on like trying to always hit on the dot, right? Things just don't hit. Like right here, we can see it was support. Right here, we can see it was resistance. It used this, tried to consolidate here, but broke down, right? It came back here, rejected it, came back down. Right now, it came right back to it. But right when we came to it, as you can see here, we got our caution candle with cheat code algo. If you don't have cheat code algo, you need to get it. It's crucial because if you don't have cheat code algo, you don't have things like a caution candle, okay? So as you can see here, the bond yields have been rising, right? And so when you see in the news, oh man, bond yields are hitting highs, money's starting to move over into bonds, okay? Right, well, remember that bonds and stocks compete for the same capital. I want to make sure I don't have any questions. Does this work for swing trading as well? What is that? What does what work for swing trading? Just get a little more specific for me so I can understand what you're talking about. If you're talking about the strategies for the dollar, you can watch those other YouTube lives we have at Cheat Code TV. So those we're talking about the strategies that you can use for the dollar, but this actually moves with the dollar as well. So I'll go over that too. So this strategy or watching this is sort of just helps you another watch thing you can add on your watch list as a tool to help you know when to make an investment or when to hedge investments. This is just something you need to watch because it's important, right? As interest rates go up, it becomes more difficult to borrow or more expensive to borrow money. It's not more difficult per se, but it does cost you more money, right? So the interest rates are going up, and when interest rates go up, bond yields increase as well. And remember that bonds and stocks are competing for the same capital. So when bonds go up, stocks usually go down. And I want to show you this. We'll take it side by side here. On this bottom chart, we'll put this on SPX, the S&P 500, okay? So I'm going to just use this top chart so we can kind of follow along here, and it'll be a little more clear for you to see. So we'll kind of stretch this out, clean it up a little bit. Let me stretch this in here. So we'll look at the same time frame. We got March here. We got July and stuff over here. So let's stretch this a little more. So you can see here, as interest rates were coming down, the market came up, right? Let me make sure I have my day chart on. Yep, this is the day. Both of these are the day. So you can see as interest rates came down, the market rallied up. As the market went down, interest rates came up. Okay. Now it's not always going to be like on the dot, right? Sometimes interest rates can keep going up, and so can the market, right? So when we look at right here, you can see that interest rates were actually coming down, but the market was continuing to rally. And even as interest rates began to rise, you can see that the market continued to rally. But these types of rallies right here are really exhaustion, right? It's like FOMO. That's what I can equate a lot of this to, because a lot of times these inverse relationships aren't spot on because you have a lot of emotions in the market. And sometimes the market can rally beyond its inverses or any other relationship that it may have because you have so much retail influence and market makers and movers, right? So you can see here that as even the market was going up, bond yields were going up too. Right. So right in this little area, bonds got support, bond yields got support, rallied up, but the market continued to rally. Right. We had this consolidation while bonds were at support. It then the market broke over this support or this resistance here. Now, as it rallied up, now if you see that bonds are getting more bullish and you see that they're on this bullish trend and they could continue, then you could be more bearish here on the market, right? Because you can see this exhaustion right now. When we turn on our other indicators, you can actually see this a lot better because you can see as we even got here, as bonds were finding support with this caution candle, as well as the green indicator, and the buy signal, right? As you can see, bonds were getting bullish as the market was consolidating. So that lets you know as a bear, oh man, my opportunity is setting up. But that doesn't mean go, right? That means let the market, like I said, in times like this, when you're dealing with interest rates and inflation, you want to be more reactive than proactive, right? Just because bonds are here to support, it doesn't necessarily mean that you can automatically say that, okay, I'm going to be right now. I'm going to be proactive. No, allow the market to set that opportunity for you because you're using this as an added indicator from the bonds to say that bonds are getting support. Right? I see that there's a demand in bonds and I need to prepare for a pullback in the market. It may not be immediately, but I realize that bonds are starting to heat up, right? And so when bonds heat up, look what happens. It pulls the market down. Okay, so as you got closer to here, you can see that, oh man, my squeeze on the market was getting hot. It's signaling, it's like, hey, broke resistance, but you need to be careful, right? Then we had the squeeze. We had a caution candle here on the market, right? When you zoom in, you have this caution candle here, plus a sell signal confirmed with the squeeze and the CCA swing. That's a 4 for 4 right there. You got 4 indicators letting you know that this is bearish. And what I'm saying is you can use these bonds as an additional indicator to say, hey, bonds are about to break over this previous level that we had right here. Because even if you use these levels, right, you can see here, and then you can say, I always call them like zones, right? So we can see that this was a particular zone. We had a lot of price trying to break through this for a while, right? These are all days. So for an entire week and a half, it just tried to break over this, right? But then it got support here. So we realize if you see bonds reclaim this area and then start to break through here and consolidate, you can expect bonds to break out of this and use this as support. And as that happened, once we broke out of here, pull the market right on down, right? So that's why I'm saying watch bonds because as interest rates increase, so will the yield on bonds. But don't be so bearish right now, right? Because when we're looking at bonds, you can see that it's actually running into resistance, right? So when we look at these previous areas, it was support right here. It became resistance here, and then it became resistance here, and then it got support down here. So we can mark these levels as well. Like I said, you want to pay attention to what's going on with these wicks and the candles, right? Where do we get these ranges, right? So we're in a range right here, okay? So as you can see, if bonds cannot reclaim this and move higher, we'll add our other additional indicators. So you can see the squeeze is moving higher. The swing is also moving higher. We have some resistance here with this caution candle at this take profit level 2 because we've seen it here before, right? But this isn't an automatic signal, hey, be bearish, right? Or be bullish in this case. I mean, honestly, with weakness with resistance here and seeing a caution candle here, bulls do have an advantage here, right? Because when you compare this with the dollar as well, so bonds and the dollar are going to move together as well. So we're going to make this larger, and then we're going to make this larger. So on the bottom here, I have the dollar. On the top, I have bonds. Okay, now these are going to move together. I want to make sure I don't have any questions. The cheat code algo, I paid, but I haven't received. Okay, working link for yes. So we have support 24/7 in the community. So if you have a question about like how to get access to the live trading and the community and everything, go email support@cheatcode.com and they'll get you taken care of. Just make sure you email them a receipt and everything, and they'll get you access. So just wanted to make sure we have any questions. Drop a 1 in the chat if you understand what's going on. Drop a 2 if you just have absolutely no clue what's going on, and I'll come to you and break it down. So back to the charts here. We got the 10-year Treasury yield bonds on the top. We got the dollar on the bottom. Now we've already, oh, no, that's the market on the bottom. My bad. Let me change to the dollar. DXY is the US dollar index. Now, if you've watched our previous lives, we've already broken down the relationship that the dollar has with the market. You realize that it is an inverse. As the dollar goes down, the market goes up. As the dollar gets support, the market tends to pull back. Okay. Now, when we look at the dollar with bonds, you can see that they actually have a relationship where they move together, right? So you can see when the bonds were really in this area of weakness, you can see the dollar was in the same place and they came down together, right? Dollar consolidated here, bonds spiked up, dollar spiked up for a second, but they both dropped down when the market started to rally, right? They both got support here. Like the dollar, bonds on the top came to the support level that you would have charted had you seen this, right? We've been here. We see the green indicator. We see the buy signal. This is a crucial level here. We need to pay attention to this. So let's mark it, right? 3.4% on 10-year bond yields is a crucial level for demand. So we're going to see that, okay, money moves in here to push this higher when we get down to these lower rates on the bonds. So you can see the bonds got pushed up. The dollar just consolidated. Like I said, these relationships always aren't going to be on point. So you need to watch them together, because if you're bullish or you're bearish, you can come check these things to say, okay, I think I need to be more this or patient for this opportunity or whatever it is, because you can see when the bonds began to spike, so did the dollar. Right. And they both have a caution candle right now, which is why I'm saying that even if you are a bear, be cautious, because the caution candle on things that are in your favor, it's a caution candle, right? Everything that would be in your favor as a bear, you had your moment right here, right? You pulled the market back. You had your moment. Things don't go straight up. Things don't go straight down. And what we're dealing with right now is a lot of a kangaroo market, right? Down, up, down, up. Okay. So you need to be prepared for these reversals so that you're not going in the market every day trying to be bullish or bearish and stuck on your idea, right? Be prepared for whatever's coming, especially if you're a day trader. You need to pay attention to these things because a lot of times they can set you up for great high probability trades. You just got to be patient for the setup. So if you're a bull right now, you can have a little more confidence because, like I said, the momentum for bears is cautious right now, right? You have bond yield spike up. That gives bears support. You had the dollar spike up. That gave bears support, right? But right now we got a caution candle on both the dollar and bond yields, right? So taking bond yields again and comparing that with the market, like I said, you can see here that when the bonds are going up, the market pulls back. Now that the bonds are running into this resistance, the market could potentially get some support to really move higher. Because if we just take a look at the market right now, let me turn on my cheat code trade management down here as well. And I'm going to turn it on. I usually keep it on low risk. I don't even know how I got on medium risk. But you can see here, we're still bullish on cheat code algo with the S&P 500. Okay, so when you're looking at that, that's why I say if you're a bull, you can get some support right here at this 4,000 level. Or if you trade the S&P 500, you could look at that 400 level for a lot of support to rally back to really test these areas at 4150 or 4200. Right, we could potentially see that prior to March. Now, the closer we get to March, the more bearish I personally am becoming, because what I see happening is that we can get this bond yields to cool back down. We can get the dollar to cool back down and allow the market to go ahead and pump some more FOMO attendees into the rally, right? Everybody that's telling their friends I'm making money in the stock market, is the best time to invest. They're getting those people right now. They want more of those people here, right? And so I believe the market will move higher and potentially retest this, especially this first take profit level. Let's go back. We'll just do one chart and look at the S&P 500 right now. So when you look at the market right now, things don't go straight up. They don't go straight down either. But right now we're back in this sort of zone that we've had a lot of gaps in, right? We've come up here and completely rejected. Come up here. This was a time that the Federal Reserve chair was talking, Jay Powell. He was talking, spiked the market up. It completely rallied down after that. Okay, completely collapsed. All right. So let me delete this so it's not in your way. But as you can see here, we got this like butterfly or dragonfly doji here, which is usually a reversal signal. Okay. Now, if you want to learn more about trading patterns and candle patterns and stuff like that, we do have our trading flashcards, shop.cheatcode.com. If you don't have them, get them. You can use trivia for them as well. We got little questions on there to make sure you're learning everything that we're spitting out for you on these cards. So make sure you get them. But this is a dragonfly doji that you see right here, which is usually a reversal pattern. So we could potentially see that basically what this candle is telling us too is that the market tried to pull us down, right? It tried to pull us down, but it closed essentially where it opened, closer to where it opened, right? Which means that the market, even though it tried to be pulled down, the bulls stepped in to save the day, right? So it rallied to close the market that day to make sure that we didn't close in these lows or potentially below this level where we can see a lot of weakness, right? Because if we can't stay above this 4,000 level or this entry level that we have here with cheat code algo, we can certainly see it breaking lower to these stop loss levels. So that's why I say don't be so bearish right now, because I think the best opportunity for bears is going to be coming towards March, because we saw the same type of thing happen in August, right? August kind of gave us a little slight bleed out, right? And then like the first week of September, it was like, hey, just kidding. Let me get some more people to be like, the bear market's over. And they're like, because what's funny is I actually had somebody write us, because at that time I was posting people, hey, warning, September is a bloody month. It's historically bad for assets, as well as March, which why I'm doing these lives and trying to warn you. But September, I tried to tell people, and then like this first week of September, I had somebody write me and was like, hey, what you think about the market? And I was like, bro, September just got started, right? I mean, it wasn't until the 9th that or the 12th where it completely collapsed, right? And that's why I'm saying what we're running into right here is historically March is not good, right? So I think that what we've been able to pull back here, we can rally into the news that we don't have yet, right? Because March 14th, let's look at it. So when we talk about the effects that the market or inflation has on the market, you want to pay attention to inflation data as well as interest rates high. So when anybody that works for the Federal Reserve is talking, you want to pay attention to that. So on February 23rd, we have gross domestic product. So that is going to be, let me actually show you all where you can get this info. Okay, so I just go here. Get it. Gross domestic product, GDP, is essentially the health of the American economy, right? So you want to pay attention to this. You also want to pay attention to jobs data. So you can get these dates. It has a schedules on government websites as well. So you want to come here, pay attention to jobs data, because last jobs data report that we had, it showed low unemployment. When you're trying to fight inflation, you actually want higher unemployment, because you're trying to destroy the economy. Essentially, you're trying to wreck it so that people don't just keep treating the dollar like it's like fund tokens or something, right? In order to bring inflation down, we need people to lose jobs. We need the economy to wreck itself in order to slow down inflation, so that we can actually mitigate what we've created, especially through quantitative easing. And quantitative easing happened through the Federal Reserve when they were pumping money into the economy in order to basically save us from collapse. Because during the lockdowns and pandemic, a lot of businesses were closed. A lot of people didn't have jobs. A lot of businesses were going out of business completely. So basically, the Federal Reserve's answer was quantitative easing. Let's pump money into the economy. But now we're having to fight high inflation. So you want to pay attention to jobs data, CPI and PPI data. You can actually get that from the same website. They have a schedule of releases for that. You want to watch both product price index, also the consumer price index. Both of those are going to be inflation data. Now, another type of inflation data that we got coming up, and that is going to be on the 23rd, is going to be the PCE index, which is the personal consumption expenditures price index. Okay, so this is essentially the Federal Reserve's preferred measure of inflation, right? So you want to pay attention to this, because this actually removes two categories, including food and energy. So this is a number that the feds are going to be watching. So on February 23rd, I believe, let me see the next date. February 24th. February 24th, they're going to release the PCE index numbers. Okay, so pay attention to that, because that's more of like, they call that the core PCE. So like I said, it's more of the Federal Reserve's measure of inflation, minus things that fluctuate dramatically like food and energy. So pay attention to these things. I'm giving y'all sauce. So write these things down. And if you want to actually follow all the meetings coming up, I actually have this saved as well. Forbes provides it. So you can have a schedule of all the Fed's meetings coming up, but there's also a government website that does it too. It's the Federal Reserve's website. They actually give you the meeting minutes here. They actually tell you when their meetings are coming up. So in March, we actually have another meeting. But like I said, before March, we have more inflation, or in March, before the Fed meeting on the 21st and 22nd, we're going to have the PPI, CPI, PCE, plus jobs report coming in from February, all in March. Okay, so literally you can be as bullish as you want right now, but as these dates approach, it's going to give us more realistic look at how inflation is affecting us. Because if we have lower unemployment, right, and we have higher inflation across these indexes, then that means that the feds will come in on March 21st and 22nd to increase interest rates, because they need to combat inflation. And inflation is going up and jobs are just, everybody's willy-nilly out here. We have to, that's not good for the Federal Reserve. So the Federal Reserve is here to be the kryptonite to the U.S. economy. Okay, so if the economy on the GDP reports, hey, we're doing great, man, we're healthy as a U.S. economy, the Fed will come in March 21st, 22nd to make sure that all that gets shut down. Okay, with higher interest rate hikes. So I want you all to be prepared for what's coming in March, because March is going to be really trivial and for bulls. Because you have, like I said, it's not so much standing in your way as of now, because the reality of the data has not hit us yet. So pay attention to these dates coming up, because they're going to be very important. And all of this information is available for you on the web, right? So just make sure you're going out there using government websites to find this. I want to make sure you all saw that. Everybody was seeing that. What are your thoughts on trading during economic meeting days? It's totally cool for me, but I say that if you see, this day right here, we're going to circle this day. right? Because when you talk about the effects of inflation, somebody actually commented, was just like, I posted a schedule, the economic calendar for the day. I was like, yo, you have people from the Federal Reserve speaking today. You have PPI data. It was either CPI or PPI data coming. And this person was like, none of that stuff even matters. And I was like, are you kidding? Is this guy even a winner? Or he must be losing and just mad at the world or something. But this stuff, it matters, right? This is what I've circled here is 2 days, right? This is the effects of the Federal Reserve, or those days approaching, right? So the day before this particular Fed meeting, you can see it was low, right? But we gapped up that day. And when you look at this on smaller time frames, so let's break it down to like an hour. We're going to go to this area that we've circled with our, oh, shoot, hold on, delete. So show you how those two or three candles that we circled turns into a lot of volatility and candles in the data. So like I said, on days like this, you want to be more reactive than proactive, okay? So when you talk about trading on days where there's economic data or the Fed speaking, notice how we broke down, right? So the day before this information was out, we were really just kind of chilling down here, right? People, and me personally, I wouldn't trade this going into the day because you really never know what's going to happen, right? But you want to trade it from areas that create higher probability, right? So when you look at this area of demand this is supply, okay? This is weakness, because you can see it comes up here, sell, weakness drops out of here, right? You can see it. And when we came into this day, you want to be more reactive than proactive, because maybe you were here, right? Market's coming in for the next day, 9:30, right? Or maybe, God forbid, you tried to swing something overnight. God bless your heart. You tried to swing something on economic data or earnings, and you thought that you could guess which way this was going to go. And you were like, I mean, if you're a bull, congratulations, right? Congratulations. But the odds of you getting this, sure, you had cheat code on your side, but still, I don't see enough confirmation here to just say that I'm willing to take a swing overnight bet here. That's why I say it's better to be reactive than proactive, right? So if you're proactive, you're trying to guess where the market is going from here. If you're reactive, you know that once the market got up here, it had absolutely nowhere else to go. Okay, that's why I say be more reactive than proactive, because if you're here, you're taking a guess, right? You could be bearish, you could be bullish. Who knows? I don't know. The market could collapse. Maybe we got some bad news before the meeting. Who knows? I don't know, but we're not in this market to guess. We're here to cheat. I want to have the best and the most high probability trades and setups for me, right? So if you allowed this to just play out, just let the day be the day. Boom. It sets you up right here. Holy moly, the market just jumped up into this area of supply. I'm going to load up on puts. This is not financial advice. I'm just saying that this is where else was it going to go? It hit the reversal bands. It had a red indicator, a huge caution candle. We already seen what happens here, right? So that's why I was saying, if you're more reactive, then you can just come in here and say, holy moly, the market is up. I need to short it. Right. That's not saying that every time the market goes up, go short it. Right. But when you see that it's in these areas of weakness or supply or resistance, then you can be more bearish, because the probability of your trade working with time is higher. It's higher for you. Right. If you're a bull here, where are you going? Where are you going? Where can you go but get rejected? Right. So that's why I say, in times of Fed meetings, economic data, as these dates approach, do not try to be proactive. Do not think that you even have the amount of money it takes to move the market in your favor, right? Be more reactive. Allow the market to push itself into these ranges or into these areas of demand, right? Because we can see as well when we had, let me see when the other Fed meeting, let's look at the last Fed meeting. So we had the February 1st. Okay, so around February 1st, right here. Okay, so even here, when we see that we're in this area of supply, right, it became this old resistance became new support here, right? And that's why I say don't try to be proactive, right? Because if you were proactive, you'd be like, oh man, I want to be bearish coming into this meeting, right? And then boom, Jay Powell says, hey, man, we're going to go lighter, a 0.25% basis points hike. We're going to be real chill. We see what's going on. And then the market's like, boom, support, right? And so you can be more reactive because you can see that as we're reclaiming this. Okay, if the market doesn't want to pull it lower, boom, I'm going calls and let's ride this trend higher, right? So that's why I say be reactive than proactive, because if you were proactive, you may have been bearish here and just, oh man, you would have gotten demolished, right? I mean, your option premium most likely went to zero, especially if you trade weeklies. So be careful out there. Don't think you can be a market wizard. It's just not good. Okay, what are your are you in Texas? No, I'm in Mexico. I'm everywhere. Because with trading, you can do it from anywhere in the world. And that's what we teach people. And that's why, even following the dollar, if you watch our other videos on dollar strategy, you can see how you can actually use that to your advantage. When traveling, you can know when's the best time to buy tickets, when's the best time to take that trip, and when are you going to get the most bang for your buck. Okay. So it's cheat codes in here. We're not in the market to guess. We're in here to cheat. That's right. And like I said, man, if you don't have the cheat code algo, make sure you don't play yourself. Get this. We also have our live community here. So you can join our community. You can check out our profit channel here. These are real people with real profits across every market from crypto. This person traded gold, the S&P 500 and crypto, right? That's the beauty of this, is that you can literally trade any and every market. And we teach you how to do that. We're not here to literally just give you all the answers, even though we do, because we do have, if you're here and you just want the answers, you just want them, you want the cheat codes, you just want all the answers. We get that for you too here. We literally send you live trades every morning with Trade Hero. Okay. And so with that trade here, you're also going to get the breakdown of that trade. We're not just going to tell you why we chose it. We're going to give you the target. We're going to give you the stop loss on it as well. And what type of trade is it? Is it a swing? Is it a short swing? Is it an option, a leap? So we're going to give you all that information here. Right. And it's going to come in pre-market. So these things are sent literally. Some of y'all are still sleeping when you get these. You might wake up to these texts. But if you want to join our community, we have live mindset classes. We did one of these today here. But with our stocks and options, we even have the trade ideas in here that you can get if you join our live community. So like I said, if you want any of this stuff, go to shop.cheatcode.com. You can get access to Trade Heroes here, the monthly community. Plus, we have our trade and flashcards that I talked about. These things are a game changer, okay? Literally, look at this. There's basically trivia on these as well. It breaks down the chart patterns and candle patterns as well. We even have a video game. I mean, not a video game, but a board game. Right. A video game would be cool, though. But that's pretty much paper trading. If you want to play games with the stock market, get into paper trading. It's not a bad idea. I think it's great to really build your confidence and learn how the prices of the assets that you want to watch move. Right. But this game is also really cool. This is really cool. So you basically buy stocks. It's like Monopoly, but with the stock market, right? You can say that price action is going to move up. You can say the price action is going to move down. You have buy and sell cards. I mean, this game is a game changer. Okay, so check it out for sure. Like I said, with all the when we talk about the effects of interest rates and what am I saying? Inflation. Make sure you pay attention to the Federal Reserve. Okay. So the Federal Reserve, their meetings, every time they talk, they could be at a conference. Make sure you pay attention. Okay. So pay attention to them. Also the producer price index, the consumer price index, and the PCE, the core PCE index that's coming up this month as well. And we got a lot of things coming in March. So pay attention to these things because they affect how the market moves. Don't let anybody else tell you that. And so if you want to learn more about how these strategies work, especially with the dollar, how to trade support and resistance, how to really watch the market and understand chart patterns as well, make sure you check out our other videos on Cheat Code TV. Also on Instagram, cheatcode.tv. Great questions. I was wondering the same. Can option premiums go to zero, then back up if you hold, or does it go to zero and that's it? No, sometimes let's say you bought Dang, them weeklies though, sometimes they can go to zero and it's it. But let's say you came in the market right here. I'm gonna break this down on a 1 hour chart. All right, so you came in the market right here. And what is this? Is this 1 day? This is 2 days. Let's say you bought a contract that expires. Okay, the 16th was this Friday. Okay, so Friday was the 16th. Let's say that right here, you were like, I'm proactive and I'm going to swing overnight a put on the stock market. Okay, so you buy a put on the SPX with an expiration right here on Friday. Okay, so you bought this put and it's a weekly contract. I advise nobody to do weekly contracts. Those are for pros. Those are for experienced traders or the insane. You're either one of the two. You're either insane and losing all your money, or you're an experienced trader and you're actually making money, right? But weeklies are deadly because they can go to zero like that. So your contract that you bought right here, notice the times, okay? So this is the close of the market right here that we're looking at the bottom right here. December 12th, the market closed. Before it closed, though, you came in a power hour and was like, oh, man, it shot up. It must be going down tomorrow, right? I'm going to zoom in so I can really play this out because some of y'all be doing this and you need to stop. So you're like, power hour, it's rallying up. It's going with inflation or Fed meeting coming tomorrow. Interest rates are going to go up. So I know it's going to come down tomorrow. So this little rally is going to be over for bulls. So you come in, you like, I'm going to swing overnight put on the SPY and I'm going to come up tomorrow. I'm going to wake up rich. Well, you woke up and your freaking put was zero. If you had a weekly expiring in 3 days or something like that, look at this. This is a whole entire, let's see. It jumped a whole $100 on the SPY, which means that your contract essentially most likely went to zero. Now, if you're just like, dang, man, well, I got into the 16th to hold it because, shuts, you got blown out. And I mean, once it's at zero, what are you going to do? Sell it back to the broker for $1? It won't happen. They're not going to buy it. So you're sitting there holding it, right? And you're like, well, at least it expires on the 16th. Well, on the 15th, boy, you woke up like you wanted to that day, right? Because then the market just, so yeah, your contract would then, it depends on how far you bought it, right? If you bought a, let's say you bought a 3,600 put, it still wouldn't be worth anything because it's the 16th and that thing is nowhere near 3,600, right? So it just depends on what you bought. If you came in the market right here on the close and you bought like a 3,900 put or 3,850 put, it would still have value here on the 16th because like, boom, you came into the money, right? So you would have some money. It wouldn't just be zero. So I hope that answers your question. I'm sure Quay has the digital version loading. Yeah, heck yeah. I don't know what digital version you're talking about. I've never seen Quay close his eyes, so I'm not sure if he actually sees. Great question. I was wondering the same thing. 3-week minimum for sure. Yeah, I say usually 30 days. So usually like a month out when you're trading option premiums. Look, this is about options and trading options. That's a whole nother monster. But usually just best practices, I would say stick to a month away because usually expirations or theta time decay is working faster within 30 days. So you're losing. Let me show you what, for people that don't understand decay. Let me just show you. They should have charts. Yeah, look at this first chart that pops up. Notice that in 9 months, you're not that bad, right? But the less time you have, the faster it moves to zero, right? So literally all option contracts are on a path to worthless, right? It's up to the price of the underlying asset to give them their value, as well as there's intrinsic value that comes from demand, implied volatility. There's a lot of stuff that comes that makes the value of your premium, but you want to understand that it is moving faster to worthless the less time you have. So when you buy more time, you're not making a lot of money. You're not making fast cash, right? But you're making money. And if you lose it, you're not losing as fast as people with weeklies, because weekly people can buy a contract for $1 premium. And the next thing you know, it's zero, right? So, but if you buy a dollar premium with, 3 months expiration or a month expiration, worst case scenario, maybe you lose 50%, but you still have time in your favor, right? So pay attention to these things, but I won't go on too deep about this. But last thing, but not least, we have this on other videos, but pay attention to the VIX, because that's another thing you need to watch. That it recently got support, spiked up, but I believe that it could potentially be pulled back down to really cool us off, to give us another spike on the VIX. Now, when the VIX is lower, this is not the time to be purchasing assets, right? Because the VIX being lower means that the volatility is building up. It ain't here yet, but something's creeping, right? And when that news or catalyst hits, spikes up, the market goes down. So right now with the VIX below 20 and really consolidating down here, that means that like we're in euphoria. We're in hopium. Everybody's smoking on FOMO right now. And if you're buying assets, you will most likely be losing money within whenever this spikes up. I don't know when it's going to happen. I'm not going to sit here and act like I know when this is going to spike, but when it does, you're most likely going to be down on whatever you just bought while it was low. So pay attention to this. This is just a great way to watch when to invest, when to be bullish, when to be bearish. This is just, and keep it on the daily because it gives you big picture, right? You can use it on lower time frames, but it's not a direct inverse, but it does. Like if the VIX is going up, the market ain't just going to keep going up. It's going to go down. If this thing goes higher, the market goes lower, right? And I'll put it to the side. I've done this before on other videos, so you can go check other videos, but I'll just show you what I mean. When the VIX is coming down, the market rallies up. When the VIX spikes up, the market pulls back. Okay. So let me stretch this out here. So when the market spikes up, you can see the market gets pulled down. When the market is low, the VIX is high. When the market rises up, the VIX pulls down. Okay, so pay attention to that. It's key to your success. Add it to your watch list, because some of y'all, I saw somebody post in our Discord that they had 100 things on their watch list. That is the recipe for disaster. Okay, your watch list should be really no more than 10 stocks, period. And if you can't get it down to 10, you're doing too much. You're doing too much. And then you ask yourself, why am I losing, or why can't I get this right? Because your watch list is too crazy. You're trying to do everything and be everybody when you need to just be a master of one or maybe two. But I'm a master of two, and that's what I stick to. Can't nobody tell me. I don't care what probability somebody gives me of a trade going in my favor. I only take trades that I see, that I understand, and that I've studied. I study the price action. I know what inverses to watch, and I wait patiently for high probability trades. So you won't see me trading every day, but stay patient. Patience pays. This whole market is a war between the impatient and the patient always wins, right? So one last question. Do you execute your trades directly from TradingView? No. And a sync brokerage, or do you chart on TradingView and execute on TOS? Thinkorswim. I don't use Thinkorswim. I use Webull. I can actually pull it up. Webull is what I use. It's cool for me. I like Webull. I use, I don't use it I use it to set alerts and stuff. So when I come in here and set alerts with it, you can also do that with Cheat Code Algo. You can come into there's a whole video on alerts. Okay, so go in here, Cheat Code Algo, buy or sell, bullish, bearish. You can do that with Cheat Code Algo, but I also do it in here. Because this kind of gives me, this is my trading brokerage. So I use this for a little bit. I do most of my charting in TradingView. And then I set my alerts here to let me know when I need to execute a trade in Webull, right? So I don't wait until these alerts are hitting, and then I execute my trades. So I'm watching both Webull and TradingView. But TradingView is essential because you can access Cheat Code Algo here, which is not on Thinkorswim or any brokerage that you may use. Is this being recorded? This is on YouTube, baby. Everything's recorded on YouTube, baby. It's going to be live here for you to watch this over and over and over and over. Digital version of the board game. Oh, that would be cool. Hey, we're going to make it happen. How about that? One last question. Cool. That's all the questions. Everybody's great. It's been fun. I really appreciate y'all showing up. Wow. Hit that like button. Holy moly. We got some people in here watching. It's freaking Saturday. Y'all could be doing anything else, but you decided to be here listening to my voice, learning about how to become a better trader and investor. So blessings to you on this beautiful Saturday. Okay. So make sure you all comment, drop us a comment, drop us a love, like, share this with somebody. Most importantly, sharing is caring. Each one teach one. Okay. Everybody needs to pass this video right here to one person so that we can share the knowledge, because none of us needs to be left behind, and no more excuses for 2023 or the generations beyond us. Okay. It starts with us. If you are the first, it starts with you. Okay. So no more excuses. I'm going to be shoving this information down your throats, okay, because it is necessary for your success. So pay attention. Want some more content and information, watch our following live videos, but we're going to keep these coming. Hit that like button before you leave. I love y'all, and I'll see y'all for the next one. Holla.